Hey guys, welcome to the Marissa Effect, the podcast where real talk meets deep connection. I'm your host, Marissa, and around here we are all about honest conversations, fresh perspectives, and living a life that feels aligned, inspired, and unapologetically you. Whether we are diving into relationships, wellness, or those aha moments that shift everything in life, this is your space to grow, laugh, and feel seen. I'm so happy you guys are all here with me, so let's go ahead and get into it. Hey guys, welcome back to the Marissa Effect. Another week. Again, I have Brooke on the podcast because this time I want to talk about finance. Finance has been a major topic for me this summer. I have not stopped listening to different podcasts that are offering different learning tools. It's just a major topic and a theme for me this summer, and I wanted to talk about it. I know I've shared with you because Brooke already did a podcast episode earlier in my earlier days in March, and she talked about being an aerialist, a fitness instructor, and all these different things. But one major thing about Brooke is that she does know finance and investing really, really well. She has a lot to offer in that aspect and realm of life. So today we're going to dive into all of that, unpack all of that, and just make it digestible for anybody who may not know about it and may be curious about it.
Most Americans, unfortunately.
I know. Well, we'll get into all of that. So welcome, Brooke. Thank you for coming back on.
Thank you for having me again.
Yeah.
I had so much fun last time.
It was.
It was.
This time we have headphones.
I know. I feel so professional right now. This is great.
I got better. Also, guys, I'm back in the office. I haven't done a recording probably since yours in here.
It feels right, though. Couch is not the right place for this type of conversation. It's like, get your pen and paper out.
Before we even start recording, Brooke's like, should I come dressed up? Like,
yeah, I need to be like business professional or something for people to believe me. But yeah, there's a lot to digest here. So I'm going to try to speak as slowly as possible, which is a challenge in itself.
Yeah. All right. So let's dive right into it. What are some topics of investing or themes that you see that people may not know about that should be common knowledge?
The thing I kind of want to start with is like, I think retirement is a big thing that people don't plan for properly, and they don't teach it in schools and everything. So when you get to be our age, I'm 36, she'll be 36 next month. Anyway, sorry to remind you, but we're already late to the party. If we wanted to start our retirement account now today, it's not going to have all of that time that it would have had if we started when we were in, let's say, our earlier 20s, when people should really be focusing on starting a retirement account. And time is the most valuable thing when it comes to investing, because it has all of that time to grow. So people that are starting now at our age aren't having all of those extra years for it to grow by the time they reach retirement. That even if they were contributing like aggressively today, it would be it would have been more beneficial for them to be less aggressive back then and be, contributing. So I think that the biggest thing is, if people aren't already at our age investing in some sort of retirement account, I think that's the most important thing that people should focus on, because you're going to have to work until you die, otherwise.
Yeah.
Or you're going to have to change your lifestyle completely. Social Security might not even exist when we're older. It's not even something I plan to talk about today.
Yeah. No, I understand that.
Yeah.
Okay, so let's break it down so it's as simple as possible, because they're large concepts.
There's a lot of different ways for people to invest money. For today's purpose of our conversation, I want to stick mostly to just like the stock market, investing in stocks, equities. We're going to go over different ways of going about doing that, whether it's in a retirement account or just in a separate brokerage account. I think that a lot of people just don't know how to get started even opening a brokerage account. Mm-hmm. And that's where they're kind of like, well, I just don't even know. So they just don't bother, or a lot of people will take their money and have somebody else manage it for a fee. And they don't realize how they could be doing this themselves, making more money probably than their money manager is making them, and not paying that fee on top of everything. So I want to kind of cover a lot of different subjects.
Go right ahead. I do find that a lot of people, maybe they don't know how to invest, or honestly, it was always taught to us like the big businessmen on Wall Street are only, the only people that know how to manage money. So I think there's some fear for people in like
back then things used to be so different. I mean, there was like, you had to call your stockbroker who was at like Wall Street, you know what I mean? There was like tickets and you're, buying and selling your stocks that way. Now it's easier than using Instagram to go on your phone and do trades and whatever else and just check, the market and everything. So once you get more familiar with just like how to read charts and understanding the major indexes, which I'm also going to go over. I think it starts to become a lot more digestible for people, and they're not as afraid of, because people are like, but I can lose all of my money. And it's like, yeah, single stock exposure, if you don't know what you're investing in, can leave you vulnerable. But when you're investing in things that are like indexes, which we'll talk about in a minute, it's like they're groups of stocks put together. So the whole country would basically have to fail for you to lose your money. And usually because there's different sectors in the market, they're not all moving in tandem, you know? Yeah. So just because one sector is doing well and the other sector is doing bad, when you're investing in these indexes, it's the average of them all. So it's like one could be up, one could be down, and you're kind of floating in the middle. But overall, if you look at stock charts over the past however many years that they possibly can zoom out to 100 years plus, it only goes one direction. So even when you're watching things and people are like, they see things dip and they get all nervous and everything like that, that's when people should be investing the most, is when the market's dipping, because it's going to bounce back, and the psychology behind it takes a while to kind of get comfortable seeing your portfolio go down, because people are like, oh, I should sell. It's the last time you should be selling. You should be buying more, because now all of your favorite stocks just went on sale, and it will bounce back. So
I like the on sale thing.
Yeah.
Before we dive right into the education of it, talk a little bit about what sparked you're very, very passionate about it. So talk about what inspired you. How did you start learning this? Because you really self-taught yourself.
Yeah, when it comes to the stock market. Yeah. So I was already doing the real estate investing stuff. So and I was pointed in the direction of a 401k. I opened a Roth and a traditional, which we'll go over that too. And so once I started seeing how my portfolio was doing so well and I didn't have to do anything, it was
this
just
is a Roth
my money
IRA,
right? They were 401ks.
Oh,
so 401ks are through a business. IRA is an individual retirement account. So we'll break that down a little bit more. So once I started making money, I really became interested. And that's when I started watching CNBC all day, which really helped, because I feel like that's where I started to finally understand everything. Because I was always asking people, I'm like, what does this mean? What does that mean? I felt like nobody was doing a good job explaining it to me. And then I would watch YouTube videos. I did read a couple of 101 investing books. And then I did take at FAU, it was an investment management. It was just like a certificate course. It wasn't like any degree seeking type of course. So I did that. And I feel like that really kind of got me the knowledge that I had, that I grew to where I am now, because then I had the basic concepts of everything, you know?
Yeah. Wow. So, okay. So let's dive right into it. What is Investing 101, or is it really Finance 101?
Finance is different. I'm going to say this is more investing, because finance, we could talk about budgeting and expenses. Okay. I did a corporate finance class also. I don't want to talk about that stuff today.
That's fine.
We'll talk about that maybe another time. But yeah, so this is more of just taking your own money and making money with your money, because
Let's go into it. Okay. You lead.
Okay. So, I think step one people need to understand is how to open a brokerage account. So there's a lot of different platforms people can use. If you're going for a retirement account, there's definitely certain ways to go about that. So with a 401k or a 403b, 403b, that's through government. So those are through your employer retirement accounts, which if your employer offers one, I would definitely recommend taking it and maxing out whatever your contributions are, especially if they're matching. And if you can max it out. Obviously people, as far as their income, what they're comfortable with. And that's the thing is you'll also figure out what your risk tolerance is. And age has a lot to do with risk tolerance also, because the older you are, the less risks you want to take with your money, because you're going to need that money sooner for retirement. Right. The younger you are, you have more time to let that account bounce back. So you could be a little riskier with it. So opening a brokerage account would be definitely the first step. So there's platforms. Robinhood's the easiest one. If you're just looking to play, there's, Charles Schwab. There's, you could do it through, I have a Wells Fargo one for my 401, and that one's Wells Trade. So basically just finding the brokerage account. You could check through your bank to see if your bank offers one. I know Chase has them. Getting your account set up is obviously step one. The next step is understanding what you're looking at when you're looking at investing in stocks. So single stocks, obviously, companies like Amazon, Apple, Microsoft, those are your blue chip companies that you've heard of. They're so big. It's it's almost impossible for them to fail at this point. Don't quote me. You know what I mean?
I get it.
Yeah. But you get what I'm saying. So, So you can start understanding how to look at those stocks. So there's ticker symbols. So when you're looking up like Apple, it's AAPL. It's not like the actual word Apple, and Microsoft is MSFT. So you get to know all these ticker symbols. So like if you're watching CNBC and it's running across the bottom, it says what percentage it's up for the day. You kind of just start to get familiar with the ticker symbol. You know what I mean? Just kind of like understanding, then looking at like the charts. I like to look at like a 5-year chart, seeing what it's been doing over the past 5 years. If I'm going to double my money in 5 years, like if it's on the path of like, it's up like over 100, 200% in the past 5 years, that makes me interested. I know that that's not everybody's type of investing style, but like at least that's going to get me interested. Like, okay, maybe I could double my money within 5 years. I'm okay with that. So I'll start like kind of looking into that first. I like to stick to companies I know. I don't like to buy into hype, because there's a lot of times where you'll be like, oh, this next company, it's going to do so well, blah, blah, blah. And, I'd rather not take other people's advice when it comes to investing, because and you should follow your own instincts when it comes to investing, because sometimes you take other people's advice and it goes wrong. So you don't want to blame other people for your mistakes. But anyway, so as far as opening a brokerage account, there's this website, I think it's like howthemarketworks.com, something like that. But you can make a paper trading account, which means you say, I have $50,000 in my portfolio. It's not real money. And I want to buy 5 shares of Microsoft. I want to buy this, that. And you could just sit there and watch what it does over a period of time. And you could see the fake money that it's making.
Like a simulation.
Yeah, exactly. So you don't have to actually jump all in with real dollars if you didn't want to. So I would recommend anybody first starting that's like too afraid to actually use their real money to find some sort of platform that offers like paper trading, which is, it's like a fake account. So you can kind of just like get familiar as far as that goes. So a big thing that just came out kind of more recently is fractional shares, because you used to buy like an entire share when you were buying a company, and some shares go up to like, some can get really pricey, but the average share is $200, $300, $400. And people are like, well, I don't have enough money to invest, Right. And that's something that you hear all the time. It's like, oh, I don't have the money to invest. Well, that's wrong, because now that you can buy fractional shares, you can invest $10, $20 into stocks at a time. So you're just buying pieces of it. So you're buying like a percentage of that stock, but eventually you keep buying more and more, then you'll eventually own a whole one, Right. So you could do these automatic transfers and everything of whatever you feel comfortable into your portfolio. And I think fractional shares is a great way for people to start, because it's like, if I'm taking $20, and putting it into Microsoft, like I'm not going to freak out overnight as opposed to a few $100s, So that's if you're buying single stocks. So single stock exposure is something that's going to leave you a little more vulnerable, because let's say if that company doesn't do well for whatever reason, there's a lot of things that can go wrong in companies, then, you're more at risk of, loss at that point. But again, these big companies is not something that like you're not as worried about as like the smaller cap companies. But so ETFs, electronically traded funds, that's something that's everybody should, because they are the reason why there's probably going to be no more mutual funds eventually, because mutual fund managers, they're charging a fee to do what these ETFs that are charging such a smaller fee, and you could just do this on your own. Yeah. So an ETF is, well, I should probably get into indexes first, but I'll explain ETF. So ETF is like a group of stocks put together that you're buying from a company, and they're like different brands. This might get a little confusing, so I should probably back up and go to indexes. But anyway, so it's a way of investing into a group of stocks without actually buying one single stock. Okay. So let's back up a little bit and go to the indexes, because this was something that was hard for me to wrap my head around at the beginning when I was trying to understand what the NASDAQ was, what the S&P 500 was, what the Dow Industrial Average was. I'm going to throw the Russell 2000 in there because, it deserves some recognition. So those are the main ones that like I would really encourage people to like get an understanding of. And once you understand it, it's whatever. So S&P 500 is the top 500 companies that are traded on the New York Stock Exchange. So that's your top 500 companies. Then you have your NASDAQ, which is the tech companies, like it's tech heavy. This is a brief explanation of everything. And then you have the Dow Industrial Average, which was the 30 top industrial companies, but now there's a lot of tech in there and stuff like that, because back when the Dow was created was a very long time ago, over 100 years ago, when industrial was like, tech wasn't really a thing. We were all industrial. So anyway, so there's the Dow, the NASDAQ, and the S&P 500. Those are the 3 main ones. The Russell 2000 is your small cap companies. That's like the 2,000 smaller cap companies that are being traded. So, and they all follow an average. So these were created by rating agencies. And you can't actually buy these indexes, but what you can buy is ETFs that these other companies have created, these like big, companies that have a lot of money, like BlackRock, Vanguard, all those. You have Invesco, Sector Spider, and all that stuff. So they create these ETFs that follow these indexes. So you can buy an ETF that follows the S&P 500. But now you can also buy an equal cap weighted, or you could buy a market cap weighted. So there's different versions. You could buy this is going to get a little confusing. You could buy the inverse of certain ones. So if it's doing well, you're doing bad. But if it's doing bad, you're doing well. And then you get triple leveraged ETFs, which get all crazy. Those have a little higher management fees. And I didn't want to get too into that because that could be a whole thing in itself. So these ETFs are just great because anything that you're looking for, if you're looking for the financial sector, because there's 11 sectors of the market. I'm not going to name every single one right now, but I'll give you a brief, healthcare, finance, tech, real estate, consumer discretionaries, stuff like that. So there's the 11 sectors, and you can buy, let's just say, an ETF that follows just the financial sector, just the tech sector. You know what I mean? So tech is a little more volatile than the rest, and volatility is something that we can also discuss. Is when people are buying and selling a lot at the same time, that's what's considered volatility. You can even buy an ETF that tracks volatility. So there's ETFs for everything. So basically, if you're afraid, I don't want to lose all my money and invest in this one thing, for example, during COVID, Peloton was doing really well.
Yes, and then it crashed.
Yes. So if you were I'm going to put all my money into Peloton, you would have been okay, that was not a good idea. But if during that same time you had bought an ETF that followed the S&P 500 or whatever, you'd be doing great, as opposed to your single stock that is doing shitty. You know what I mean? So
I forgot all about that.
Yeah. So there's so many other companies that I could use as an example. So, so that's what ETFs and indexes are. Hopefully that gave a better understanding of what those things are. ETFs are something that you can buy from multiple different companies, and a lot of them are going to look the same because they move in tandem with the market, but there's different management fees. Then you have things, so dividends are something that a stock will pay. Sometimes they're paid out monthly, quarterly, annually. So it depends. So dividends are also a great way to pick which stocks that you want, because that's guaranteed income. So even if the stock is it's not really doing much, you're still getting that guaranteed income. And then you could do something where it's called a dividend reinvestment plan, or you can manually do it, but where you take whatever that money is that dividend paid, and it gets reinvested into that same company. So now you're buying a fraction of a share with that dividend that just got paid. So ETFs, I was saying, you could buy a high yield dividend ETF, which just has a group of high yield stocks, and then you're going to get that dividend off of them. But again, they have management fees. They're not nearly as much as mutual funds. So the reason why I don't encourage mutual funds, and I don't think anybody should really, because all of this information is so available to you, and gaining that financial literacy and confidence, I think goes a long way. And when you have somebody else managing your money, you feel so reliant on them. And then they're not as concerned with your performance of your portfolio, because sometimes they're either making money off of the total amount you have invested, or sometimes it's performance based. But either way, they are probably not outbeating the S&P 500. So the S&P 500, like I told you, is the top 500 companies that are being traded in our country. So when the average of them goes up about 9% year over year. Some years might be down 10%. Some years might be up 20%. Overall, when you back it out and you look at the average, it's about 9% year over year. So most money managers don't make that much on them. They'll claim they do, but you really got to see, because majority, I'd say at least 90% of money managers don't beat the S&P 500. So if, let's just say you're where do I start? You could just literally buy an S&P 500 ETF from one of those companies I named, and you would be so much better off than if you were investing with a mutual fund manager, or if you were buying, Apple. Apple is probably always going to outrun the S&P 500, but it depends. It depends on the years. You know what I mean? So, but then you're also taking a bigger risk going into that single stock. So I think that the safest, best way for people who are first starting is to look into ETFs and try to, find what works for them. The risk tolerance thing, that's another thing. Was saying that I was on the younger side when I started. So I really liked tech-based stuff, because yes, it's riskier, but it also I just think the future is tech. So it's the growth, and everything is there too. So, yeah. And as far as what I was saying about the dividends reinvesting, that's how you create compound interest. Should I take a breath before I get into compound interest?
No, I was waiting for you to, because
Yeah. Ask the question first and then we'll talk about that.
I mean, people are going to disagree, but I guess I'm a safer person. I only invest in the dividend.
Oh, in the high yield dividend stocks?
Yeah.
I mean, that's great, especially like if you're reinvesting those dividends or buying more stocks and you're not cashing that money out. Right. Because, I mean, some people that have enough money invested, like huge portfolios, they can live off those dividends.
I mean,
that could be their monthly income.
I have that I haven't bought myself shares of, that I look at my account, because I'm obsessed with my account, but I'm not obsessed where I'm looking. Like, CNBC is not on my TVs all day. But like, I'll look and I'm like, oh shit, it's working for me. Right. Like, I don't even have to pay attention. I will. It's
nice to check it once in a while, not every day, because the day-to-day might stress you out. But then when you wait a little bit, you look back and you're like, oh wow, this is great.
I didn't even, I had bought so many, and now it's like, okay, I ignored it I abandoned it for a little bit, and now I see it. Honestly, and now I see it kind of working for me, and that's a cool feeling.
They say that like the best investors are the ones that forget about their portfolio. And
I'm like a fake
forget about it. Yeah.
I'm like, I won't allow myself to be obsessed and consumed with it, but I definitely don't want to be
good to pay attention to
not
it.
Educated about it.
Yeah, no, you've definitely like taken an interest in all of this, and I think that you have a better understanding of all of this than most people. So
it's good. But I will say sometimes I do ignore it. Like one time I went into my account and there was a stock split. Yeah. And I'm like, wait, what the hell happened? How did I get all these? Yes. But so like talk about that a little bit, because I ignored it. And then I went in and I'm like, oh, wait, when did I get all these?
Yeah. So most of the times it's split. Sometimes they consolidate the shares. So it's like, you could have had like 20 shares and all of a sudden you have 10 or whatever, you know what I mean? Sometimes it could be a 3-to-1 split. It could be whatever. So let's just say if it was a 2-to-1 split, that means for every share you now have 2. But let's just say the share was trading at $1,000 and it did a split. Now you have 2 shares for $500 each. So you actually don't make any money off of a stock split. Sometimes it creates a little hype in the company. So you'll see like a little bounce from it or whatever. But it just kind of like makes it, I guess, more obtainable to the average person. That's like, that share that was $1,000 is now only $500. But
I just think it's important to know, because I had no idea. So I was like, wait, what the hell?
It gets a little confusing.
Yeah. So I think it's good information.
Yeah, there's reasons companies do it to make more shares available. Sometimes they do share buybacks.
Well, I realize, I guess when there's a big bubble and the share is getting too large, they want more people to buy it. That's how
the price. Yeah, sometimes the prices get too high on the share, so they just want to lower the price of the share, so they'll just offer more, or they want to create more shares, because when you're looking at, let's just say, individual stocks, you'll see how many shares there are total, and not every company has the same amount. That's why you're gonna be like, oh, well, why is this stock more expensive than that one? It's because maybe there's like 1 million more shares available than this one. You know what I mean? So it's just the way. Okay. So another thing that people should really look at, because you can't just like be like, oh, I like this stock, I feel good about it, I'm just going to buy it. Price per earnings is a really important thing to kind of understand what it is, even though all these tech stocks are trading at like stupid multiples, because price per earnings should trade, the average market, I think it's like 17 times price per earnings, but like you'll look at like Tesla, it's like 32 times price per earnings. Like, you know what I mean? So a lot of these companies, people are buying for the future growth and the value of, so people are willing to spend more than what the average is price per earnings. That's as far as I want to go on price per earnings. So, you know what I mean? Like there's a lot more details that you can look when you're trying to figure out if you want to buy a stock, but price per earnings is a good one to know if it's overvalued or undervalued. So that's something like Warren Buffett looks at. I know I made a little note to myself. I want to talk about Warren Buffett. Yeah, I love Warren Buffett.
I always talk about him to Joel.
Oh yeah, he
drives a Honda Civic.
He still lives in the same house in like not Oklahoma. Is it Oklahoma? Yeah, somewhere like that. One of those.
I think you just need to know about it. Okay, so anyway. Sorry, I'm interjecting. But I do feel that once I stopped letting the fear of intimidation rule me, and I started to take on interest because you kept feeding me education, I was like, wait, now honestly, I'll sit at a table with finance guys and know exactly what
you can hang in the conversation. Yeah.
So, but I don't let it anymore rule me. Like I'm not smart enough. I'm dumb. I don't know how to do math. You don't even need to be good at math. You just need to conceptually understand what is going on, and it will serve you. And I think females are better at it. I don't know.
They do say that because they're more calculated.
Calculated, but you have intuition. Like I have gut feelings on like certain things. Some things I'm like, okay, that's not really the greatest. But also like I think
But they do say women make better investors because we are more calculated. And like I've seen guys do their investing and they're like buying high, selling low. I'm like, what are you doing? you know? Or they're riskier. They do doing like options, like calls and puts. And I don't want to get too into that either today because those are derivatives. Yeah. And that's like more of like the gambling side of the stock market. And you can buy future contracts and stuff. That's some fun stuff, but that's like more advanced. So we're going to stick to the 101 stuff today. But there are things out there called options, and you can basically bet on the future prices of these shares. I'm calling it bet because that's just how it works in my brain. But yeah, it is. It
becomes like a video game.
It's riskier. The risk is higher, but the reward is higher. You know what I mean?
Yeah.
Yeah.
It's fascinating concept.
Yeah, the video game thing. Like I did feel like that at first, but it's that dopamine. You know what I mean? It's like the Robinhood account that I have because I have a bunch of brokerage accounts because I like to like split them up for different reasons. But like the notifications that I get, it's like the slot machine feeling where you're just like ding ding ding. You know what I mean? It's like this is a 5%. And it's keeping it front and center in my brain. So I'm just like, oh, what's this? I got to check my portfolio all the time. You know?
And when I started getting into it, I would pull up CNBC. I would have the app on my phone and be like, oh my gosh, I feel like I'm an ESPN like
to me that was like sports. Yeah, they would have like the halftime report for the day.
Know what's going on?
Yeah.
And I care because I'm invested now, and like it's my money's in there too. So it's like a great feeling.
I remember. I did say that before. I was like, this is like my sports. You know what I mean? I watch it on TV. It's exciting for me. But yeah, so.
So if somebody hasn't played yet and wanted to, okay, this is like a good rule of thumb too, because I have my play account where I like do my investments.
Right. Not your retirement account.
Not my retirement plan.
You can pull it out if you needed to. Right.
If I needed to. I'm not because I'm neurotic, but like, but then I have my Roth and then I have other things. So like, let's talk about that because people earn and then they don't know really how much should go into each and every account. Yeah. Also, they don't, I am finding through basic conversations with my friends, like they don't know like how much is going to play into a fact when they get older.
Yeah, that's
why their contributions matter now.
Right. I think they matter way more now than later because let's just say we're 36, let's say we're contributing heavily now.
You're 36.
Okay, 36. Kidding. Anyway, so let's say we're contributing heavily now. It has like, let's say another 10 years before we're 46 to grow. But let's say if at 46 now, I'm like, no, I want to be aggressive now. I missed out on 10 years of my money, like making money on its money. And then especially I was going to say the compound interest stuff, we're going to get there. But I want to break down the difference between a Roth and a traditional. Because
let's do that.
That's something that a lot of people don't understand. And there's different benefits for different times in your life. But I really think that having both is the right answer. So a traditional 401k or a Roth means that you're deferring the taxes that you made this calendar year and that money is going into your retirement account. But when you retire and you pull the money out, you will have to pay taxes on the money that your money made. So the benefit of that is that you think you're going to be in a lower tax bracket when you go to retire. So I feel like that's okay for people that are like closer to that age of retirement. The Roth IRA or 401k means that you're paying the taxes on it. Like you made that income this year, you paid the taxes on it. Now you invest it. And when you go to cash it out, you're not paying any tax on that money when you go to pull it out. So all of that profit that money made, you're not paying tax on it. So to me, because I want my money to have all that time to grow. So when it grows, you know what I mean? I can pull it out. I don't want to pay taxes on it by the time it grows because I'm anticipating it's going to be a lot bigger than, you know what I mean? So at the time when I pull it out. So, and when you can pull it out, by the way, in a retirement account, the age of retirement is supposed to be 65, but you can pull it out without a penalty at 59 and a half. Yeah. So you can pull your money out early. But if you do want to pull your money out of a retirement account earlier than that, you will get penalties. Yeah, there's a tax penalty that you'll have to pay. But if you put it back within the same calendar year, you don't get penalized. There's other ways that you can also borrow against your retirement account to invest in other types of investments, but I would talk to like your tax professional about that before, taking my advice.
Yeah.
But so that's the difference between Roth and traditional. Traditional, you're paying the taxes when you pull it out. And you're not paying the taxes this calendar year on the money you made. So maybe your taxes will be a little bit less this year, but then the Roth, you're paying the taxes now and then it grows tax free. And then when you pull it out, no taxes. So it's good to have both because if you're closer to the age of retiring, you know what I mean? Like, I think that the traditional could make more sense than the Roth.
I do wonder if people who have a pension do that then open up like a Roth 403b because that
I'm not sure. Do they ask you when you're opening your account?
I'm asking you now.
No, I have no idea.
I'm gonna ask because I don't know the answer to that.
So like a lot of times when you're being offered an retirement account through like your employer, it's not self-directed. So you're not going to be able to
401k. Is that tax deferred?
Yeah, 401k and a 403b, they are the same thing. Just yours is the 403b is through the government. Yeah, so it's the same concept, just different where it's coming from.
But they're both tax deferred.
Yeah, but they're in different ways, depending if it's Roth or traditional. So people usually think about Roth and traditional when they're thinking about IRAs, but you can do a 401k like that too.
But I'm assuming my pension probably isn't taxed right now. I'm sure I'm going to owe
no
taxes
idea about pensions. I'm
just saying, if somebody didn't have both, can they use their pension as in place of like opening up a traditional?
I don't know. I'm not sure about what pensions even like look like, to be honest. I don't have one, so I have no idea. But so between a 401k and an IRA, I think it's also good to have both too, because it depends also like how much money you plan to invest, because your 401k, I think in 2025 maxes out at like 23,000 that you can contribute for the year. Your IRA maxes out at, I think, $7,000 in 2025. But let's just say your employer gives you a 401k, but it's not self-directed. So you give them basically your risk tolerance. Yeah. And then they diversify for you amongst all these different ETFs. Maybe you'll have some bonds. Maybe you'll have some foreign currencies and stuff like that in there. But your money is being managed and you're being charged a fee. So let's just say if I open up separately than an IRA and that is self-directed, that I have complete control over what I'm buying. You know what I mean? Like it's up to me to make those decisions. I'm not being charged that management fee. So there's benefits to both. I do have a 401k through one of my businesses that I'm my own employer. I was able to set it up, whatever. So mine is self-directed. So you can get 401ks that are self-directed, but it just depends on your employer, basically. Okay. So yeah, most of the time they ask, what's your risk tolerance? Like, you know, low, medium, high, basically. And then they diversify it amongst that. There's like,
but isn't it important to know? Okay, because I struggled with this with my own personal life. I was investing for a long period of time in my 20s, and I had no idea what the hell they were doing with the money. Yeah, and a lot of people I find do this, especially in a
they have no idea.
That's the only world I have ever worked in. So I know a lot of like finance people come into these schools, they sell them this plan, but then they don't know what the hell their money is doing. No, some of them are like annuities, and it's just unfortunate. I think it's really important for you to know
people
what your
need to
money
educate
is
themselves.
doing.
Yeah, because then they're being taken advantage of, you know, and your money can be making more money than it is with these managers, and they're the ones making the money, not you. You know. Yeah.
So I think it's really important, but I kind of lost my track of thought where I was going with that. But I think it is important for you to know what I know it sounds far away. It sounds like a retirement plan. Some guy came in, sold you a package, sign here, and you think you're just going to have this large lump sum when you get older. But that might not be the case. So like you really have to like ask these questions. It doesn't matter if you think you sound dumb in front of this guy. You need to know what you're being invested in.
Well,
like diversification, like you use that word. Some people might not even know what the hell you're talking about.
Well, speaking of diversification, because I actually popped into my head while we were talking. So like when it comes to risk tolerance, a lot of like a kind of rule of thumb, I think it's like your age is like what amount of bonds you should own versus stocks. So like, let's just say I'm not 30, but let's just say I'm 30. So that means 30% in bonds, 70% in stocks is like a nice diversification. And then of course the stocks that you have should be diversified amongst those 11 sectors. And then you can invest in more things than just stocks and bonds. There's, you know, like I was saying before, foreign currencies, there's so many different things that you can invest in, commodities and stuff like that. But that's not what we're going on today. But
it's just so much to learn.
So I do want to talk about compound interest because it's the eighth wonder of the world. It really is. So with the dividend reinvestment plan that I was talking about, and there's other ways. The drip plan. Yeah. So the drip. But when you start investing your dividends, that's money that your stocks made. Sorry. So that's money that your stocks made. Now, if you're reinvesting that, you're your interest that you made, which is money you didn't have before, is now creating more money for you. So now you're getting like all this like free money in a way. So let's just say I own a share of, let's just say, I think Microsoft pays a little dividend. So we'll just use that one. So let's say I own Microsoft, and every time it pays a dividend, I'm reinvesting my dividend. And let's just say I own 10 shares of Microsoft, but every time it pays, I get another 0.1 per, whatever. And then eventually I work my way up to now I have 11 shares.
Right.
And that 11th share is also making a dividend. So then over time, it's going to start multiplying exponentially. So there's this thing called Rule 72. So if you take the interest rate and you divide 72 by the interest rate, that's how many years it'll take your money to double. And that's important when it's coming to compound interest. And that's really important to know. So let's say you're making money at 10% and it's compounding. Every 7.2 years, your money is going to double, So once you start to understand compound interest and your money starts making money and you start making money in your sleep, you know what I mean? That's really where like your wealth will start to grow, is that compound interest. So the biggest thing to take away from today is like, do some research and everything about, opening an account if you don't already have one, but compound interest is very important. So so dividends in the stock market is the main way that we're going to talk about getting compound interest. There's other forms of investments that I've done that like accrue daily compound interest, and those are amazing, but those are like tax certificates they have to do with real estate, and we're not talking about real estate today.
Wow, so much to learn.
So like when the market's not doing well, a lot of people
let's talk about that fear.
So you want to be fearful when people are greedy. So when the market's doing really well, that's not really when you want to buy, and you want to be greedy when people are fearful. So when everybody's panic selling, you're like, okay, this is time to buy. Same with real estate too, but we're talking about the stock market again. So so I would say buy the dip. You don't know how low the dip is going to go, but just keep buying it, because then that's what dollar cost averaging is.
But that's how it was taught to me. Like it's on the market's on sale, buy now. Versus like I'm losing all my whole life. I don't know. There's a lot of fear out there, but it's on sale, so go ahead and go buy.
I mean, if you're willing to buy it at $300, are you willing to buy it at $250? It's on sale. And then again, the market really only goes one direction when you're looking at the market as a whole.
So let's segue into like charts. So some people just see lines on a screen, numbers green and red, and they just don't. They think, oh my gosh, this must be something.
Line charts are typically like on the easier side to understand, and then there's also the candlestick charts, which candlestick charts I think are for the more advanced traders that are trading options and everything, because you can start reading patterns, so you can start to predict like what the stock is going to do. So that's why I was saying it's more of like a gamble. So you can start like betting on what you think the stock is going to do. I mean, options are a whole thing that we could get into. I mean, there's different ways to read them. They have the Greeks where the time decay is a factor. So as things get closer, the time starts speeding up and the prices start to like, as far as if you're buying, they start to lose value as it gets closer to that expiration date because of time decay. There's so many factors when it comes to volatility and everything. But that and futures, those are derivatives. Those are things that like, unless you have a good understanding of how the market works, like I wouldn't even bother educating myself. So you say you want to buy something new that you want to add to your portfolio. Okay. How do you make this decision? Like paint the picture for us. Let's just say I hear some hype about some sort of company that I'm not too familiar with. So I'll start looking. That price per earnings is a good place to start. I'll look at a 5-year chart and I kind of like, okay, it's been doing well the past 5 years. Hopefully the next 5 years are going to look similar. It's not always like that. You know what I mean? So, but then that's also why I kind of feel like I stopped kind of buying things that I didn't know. So like even Warren Buffett says, he's like, you shouldn't own like 30 companies in your portfolio, because like, how can you even know what 30 companies are doing? Yeah. So it's like, you're supposed to like buy stocks and kind of just like let them sit there, but still pay attention because, like I said, the Peloton thing or Celsius is another stock that I've invested or Etsy, you know what I mean? They were good. They were really good until they weren't. Shopify. I mean, these were all things that I definitely like bought into. And then when I started seeing them start to decline, I did sell, which was good because they did hit bottoms that I never reached. And I still was up at the time when I sold them because I like, bought at a good time. So there's safer ones to buy. I think ETFs are the safer option because you're not just buying one share. You're buying, like, let's just say this company owns all these shares and then they divide it up into their little ETF packages. And then they're like, here you go. This one's $250 and it's got little pieces of all these other companies in it. And it just goes the average. It's not like, as volatile,
So where can somebody go to obtain knowledge? I mean, now we have ChatGPT.
I think everything's available online. I mean, like you.
But is there anything you learned from that you're like, okay, this really helped me?
I honestly, the investment management class at FAU, I think gave me a lot of just like knowledge that you're not going to get from CNBC and you're not going to get just from these like investing 101 books or whatever. Like we went over all sorts of stuff like standard deviation and beta, like the time decay things, like we really got into like the details of it. So I think that was really beneficial for me.
At that point you had so much knowledge.
I had some. I already had my 401ks. But I didn't know as much as after I finished that. And it was like, I think like 8 weeks or 7 or 8 weeks. It was like one night a week, but the course itself was like $1,000 or something like that. So, I mean, it's a little
not
pricey.
Everybody has to do that.
No, you don't have to. I just feel like that's where everything kind of like made sense to me after a little while. So yeah, I think like there's just so many resources online. You can go anywhere.
I mean, do you see that? Like the world is so changing, especially with ChatGPT being accessible to everybody at any given point. Like, do you think there's going to be people that
ChatGPT is going to be a better money manager than your money manager?
Okay, that's kind of where I was going.
Just be like, hey, I'm looking for
the other day.
Yeah, it'll give you how to diversify. It'll tell you everything. It's a him. Is it it? I don't know. What do we say?
I call him it. But like I asked him what the ticker is for the, and it was just and then all the information, it was like, I didn't even need to go elsewhere.
Yeah.
Oh, wow.
You can ask like, should I buy this stock? And I'm sure it'll give you like the buy or sell.
It doesn't give advice.
It won't give it. Okay. I haven't tried that
yet.
Asked. But I'm sure it'll tell you like the steps of how to get set up and like what to look for and everything like that. Yeah.
Yeah.
So,
you like Robinhood to start.
Robinhood's easy. Some people, not everybody's going to agree with me on Robinhood. Okay. You know what I mean?
Especially after Charles Schwab. But you always said you found Charles Schwab to be a little bit more. It
was harder to use. Yeah, because I had TD Ameritrade, which Charles Schwab bought. So now I do have Charles Schwab, and I don't love it. Like,
I like it. That's all I know.
I think it's good for advanced investors. You know,
I'm not advanced, and I like it.
It's confusing.
Really?
Yeah, I just feel like Robinhood is just like the information is just like so like user friendly. They dumb it down so much. Yeah. And they make everything just so visually just like pleasing. You know what I mean? Like Charles Schwab, like nothing was pleasing about looking at that app for me. You know what I mean? This is like, I don't know, it's like the friendlier version. I just think that it's like for a beginner.
What about
Vanguard, if they have their own
I think
trading,
they do.
Yeah, you can always use any of them. Unless they're charging per trades, which Robinhood was the first brokerage account that didn't charge per trade because there used to be like a $5 or $6 like transaction fee basically every time you traded. And once Robinhood started doing the $0 trades,
they all competed.
All of the brokerages, so pretty much you're not paying per trade, but you just have to see if there's any fees involved. Yeah. If there's none, the only things that I would be concerned with: can I buy fractional shares, and do they have the ability to set it up on a dividend reinvestment plan? Because those two things I think are the most important.
But I can't remember, but I'm pretty sure like it was just an app that I just had to toggle with, and like I don't think you need to talk to anybody to make it a drip. No,
you don't have to talk to
I think you can do it.
No, you just have to see if it's available on that platform. Yeah, you don't have to talk to like a human. You just have to like, see if those things are available.
I mean, why would somebody not choose that? That's the part that I don't get.
The dividend reinvestment?
Why is it a question? Like who says no thank you to that?
So the dividend reinvestment? Yeah. So that's what I was saying before. Like let's say you have $100,000 invested in a stock and that dividend that's paying you is your income. You're living off of that. Like some people do that as an investment and then they use that dividend to pay their expenses, or they're going to invest it into something else, you know? So sometimes that's literally income. That's how people make money, is just by investing in dividend stocks and just using the dividend as income.
But that's what I'm saying. So it's on and it's benefiting them. Mm-hmm. Who is out there saying, no, thank you. No, thank you.
Yeah, let's say I'm retired. I'm living off of my dividend.
So so
my money is staying in the stocks, but I'm getting paid the dividend, and now I can just take it out and I can pay my mortgage.
I need the money now.
Yeah, I can pay my mortgage with that dividend. You know what I mean? So you don't have to reinvest it. It depends. That's the thing, is everybody's.
I get it now.
Yeah, like just what works for them is not going to work for the next person based off their income, where they're at in life, what their expenses are, and everything. You know. So yeah, I want to say be aggressive, contribute as much as you can. But some people can only contribute $20 a month. Yeah. Some people can contribute $2,000 a month. You know what I mean?
Even if you only have $20 a month, just freaking throw it in there.
Do it, yeah, because that fractional, if you're able to buy fractional shares, just get started, you know?
Yeah,
so,
I think so. Because I think a lot of people fixate on, I don't have the money, the sum of money that it requires. So I'm just not even going to bother. And like that hurts in the long run, way worse than having a little bit.
I've talked to people and for the past 5, 6, however many years, and I'm like, trying to instill this in them or whatever to invest. And I've heard the same thing, like, oh, I don't have the money to invest. I don't know. And I'm like, do you know how much money you would have made off $20 a month all this time? You know what I mean? Like you lost out on that. And so like people are seeing the light. It's, it's getting there.
It's getting there.
Yeah. So one thing I will mention also is just briefly is like when you're paying taxes on these things, capital gains taxes. Yeah. So there's short-term versus long-term capital gains and everything like that. So if you're just like holding things for short periods of time and selling them in your portfolio, you're going to have to pay taxes on that. So when you're holding it and you're not selling, you're not paying taxes until you do sell. So just keep some of those tax implications in mind because like, I know in real estate a little bit more about tax law than I do as far as because most of my stuff is just like invested. I'm not cashing it out. Yeah. But anytime I do move things around in my brokerage account, the one that's not my retirement account, I do get like a 1099 at the end of the year. So yeah, so just keep that in mind also.
Can we talk about Bitcoin and
Yeah, absolutely.
Okay.
Yeah. I mean, when it comes to cryptocurrencies, it's a little bit of a joke out there right now. You know what I mean? It was worse than it is now as far as just like the meme coins or whatever else that are going on. The one Bitcoin makes sense to me. They call it digital gold. There is a finite number of Bitcoin that will be mined. I think 2142 is the last year that there will be a Bitcoin that will be able to be mined because every 4 years, the amount of Bitcoin that exists halves. So let's say, in 2024 was the last halving, and the next one's going to be in 2028. And if you look at the chart for Bitcoin, every 4 years, it goes up. So we're trading in like the $100,000 range right now. So back it up 4 years ago, you're going to see how much it went up in the past 4 years. So Bitcoin is definitely something that I would say everybody should have a little bit of, and obviously you don't buy a whole one, you buy pieces of Bitcoin, you know what I mean? Just whatever you can afford. Robinhood lets you buy crypto. Not every brokerage. I don't think so.
I don't know.
So stay away from Coinbase. We want to get into that right now. Anyway, don't go to Coinbase. You can do it through Robinhood. I have also a Public. The app is called Public, and you can buy all sorts of crypto on there that you can't even get on Robinhood. But I'm not playing around with all those dumb little, crypto coins that come out.
Talk a little bit about that because there is fear around there because not everybody is a trusted person. So
I mean, right now it's all speculative. You know what I mean? It's like I do believe in crypto and I do believe in Bitcoin. I believe in the blockchain technology.
Our new currency.
I think the blockchain technology is something that I think that we're going to definitely see more of it starting to take over, even in just like legal type of situations like real estate transactions and everything. But other than that, I think for crypto, the things I would pay attention to, the Ethereum network for blockchain is also something that I think is going to be used like in the future more than we're using it now. So I think that's something to pay attention to. So really those two are the ones I care about.
If they don't have Bitcoin right now, are screwed?
No, I think that they should still get some, what I mean? Because we're talking about like the future value, what I mean? So I'm not saying like go buy your Bitcoin and then hope that it makes, X amount of dollars by next week. No, this is something that you should invest
if people didn't have it yet.
I think there's all sorts of stuff that's going to become like regulated with cryptocurrency. So there's still a lot of things that I think
it's still
right. Well, they can't fully regulate it right now because it's not a security. You know what I mean? So it's like, So the whole point was that it wasn't government regulated, but now the government's trying to get in it, and now the U.S. is like trying to own X amount of dollars in reserves of Bitcoin, and they're mining their own. So I do think that there is.
Talk about the Federal Reserve.
The Federal Reserve, I mean, they're the ones that control the interest rates and everything.
Yeah.
Jerome Powell.
There's so much to talk about.
There's
the older me would benefit from like taking like an economics class.
Yeah.
Honestly,
I do find my way fascinating. I want to take a tax preparation course. I know it sounds so boring, but I like want to know tax law.
It's crazy. It's like what you care about as you get older.
I know. That's what I was saying earlier. I'm like filing cabinets I used to get excited about. Now it's everything's digital. But.
Crazy. What else is on there that we could share?
Well, it's just like I did put on here like about as far as psychology when it comes to investing. Like you feel the losses more than you feel the gains. So just know that like you're gonna.
But can I say? I mean, I'm not this major investor, but I do think that Okay, wait, I was saying it to you before. I do think that as long as you're educated and you believe in what you invested in, you won't have that fear, sell everything. Unless like, and then when you're so educated, you can make the decisions like you did, and you can sell before
once you
it gets
see a few
really
dips,
bad.
That's the thing. Yeah. It's like, you have to make it through a few dips. Like, I made it through the COVID dip. I made it through like a bunch of other ones that like, I was like, what's happening? I was doing so well, and now it's all gone. And then all of a sudden I was like, oh, it bounced back, and now it's even higher. And I'm so glad I bought things when they were on sale, because now those bounce, and now I'm like better than I ever was before. So I know, like, we're not going to get into politics right now, but my portfolio, a lot of people are like, oh my God, we're going into a recession, whatever. Check your portfolio if you're already invested. You're doing all right.
No, I get that. Yeah. No, and I get that.
We'll see.
I just gotta ride it out. But the thing is wait, there was something else that came to my mind and it left me again. Shit.
Story of my life.
Shit. Okay, so yeah, basically the psychology of it. I do think that as long as you're educated, you believe in what you have, and you're monitoring it, you're not getting obsessed with it. I also think the more you share with others, the more fear you take on of other people. So if somebody's like, I'm selling all my shit, the stock market's going down and America's crashed. I mean, people say crazy things.
Oh, trust me.
I mean, you're bound to get crazy, and you're bound to make these bigger decisions. Yeah. So I don't think you have to.
I don't flinch when the market goes down now. I used to. No. I used to be like, oh my God, this sucks. And now I'm just like, well,
I hear older people say like, you gotta.
That's why people want their dividends when they're older. They're just like, I don't care what that stock is doing. I just want to make my money. That's all they have to get. Because the stock doesn't have to be doing anything special for you to still get paid on it.
I know.
So inflation is something I didn't talk about that we need to discuss. That was like the first. That's where I wanted to start. So, retirement aside, your money sitting in your bank account right now is losing money due to inflation every year. Healthy inflation is 2.5% to 3%. I mean, in recent years, we went up past like 7%. I think we're teetering somewhere around like 2 to 3% right now. I don't know. I got to check. I haven't looked in a little while. But let's just say you're leaving your money sitting in your account. Every year, you're losing whatever that inflation amount is on your money. You know what I mean? So your money's actually losing money. So having your money invested, at least you're trying to outrun inflation, because like your money is like
it's legit game.
It is. Just because let's say you're making 9% on your money, but you're losing 2% to inflation, you're making 7%. But if you're just letting it sit in the bank account, you're just losing money every year. So
are there any savings accounts, high yield savings accounts that
your high yield savings accounts are like not even going to pay 1%?
So like, what would you do? What's your recommendation for people who have money in a savings account right now?
If they have a significant amount of money in the savings account, I mean, that is doing you no favors.
That's what I'm saying. So what's your recommendation?
My recommendation, I will stick by the S&P 500 just because I think it's like.
So you say no savings account, all in the stock market.
Risky investment for people to make, to be able to like, and it's liquid. It's not like you're buying real estate where it's like, it's not easy to sell real estate like it is a stock.
Oh, okay. Yeah.
You know what I mean? Like you want to sell a stock that day, you sell it that day, So I think that the least risky way for people to start is open a brokerage account, find an S&P 500 ETF, like Sector Spider's S&P 500 ETF. The ticker symbol is SPY, SPY. So if you want to just check that one's a real easy one. VOO, VOO is like Vanguard's version of it. There's so many. So it's like, you can drive yourself crazy trying to figure out which one's the right one. But they're all very similar. They're all their charts are going to look the same. Their management fees might be a little bit different, but I mean, we're not talking about like big dollars.
So you say go buy a bunch of shares of that, and then
even if it's just a fraction of a share, start there. You know what I mean?
No, I'm saying for those who have a savings account.
Oh, if they have it. Yeah, you know what? And dollar cost averaging is something I mentioned before. So you don't have to take all of it and buy it at once, because let's say it goes down over the next few days, a couple dollars. You could have bought it at that lower price. So maybe like you buy 5 shares this day, 5 shares the next day, and you average your price of what you're spending.
Well, I guess if I'm doing it kind of your way. I thought it was the wrong way, only because you don't feel. I don't feel like it. I was saying this to Brooke. I feel like when I put money in an investment plan, it's like can't touch it. It's invisible to me.
Well, that is the best way. The best approach.
I almost have like broke. I am broke, but like I have that mindset because once I put it to something, I don't want to ever take it out.
Yeah.
So like once you're borrowing it from yourself, I was borrowing money from myself.
In your savings account?
Oh, yeah. Tell myself I'm going to pay myself back. But that's
when it's in a brokerage account,
it was not
you feel
working.
like it's more locked in.
But once I put in something serious, I was like, my dad was asking me, how much are you saving? I'm like, I don't think I am. I'm not. Like, but I am. I have the money. I'm putting the money. But in my mind, I can't take it out. So it's like in prison.
Yeah. It's cool to see.
In a long-term prison.
For me, it's cool to see also. I'm like, wow, not only did I save all that money, but now it's like doubled, since I've invested it. So that's cool.
Yeah.
One other thing I wanted to mention, which is like when you are buying a share, you have the option to do a market order or a limit order. Most of the time you're just going to do a market order. But if you were like, I want to play a little bit, and let's go back to like Microsoft, let's say it's trading at $200, but you're like, I think it's going to dip down to $195. You could set a limit order and put an expiration date, whatever, and put $195 as your purchase price. And if the stock touches that $195, it automatically triggers like a purchase. So you can, play it that way a little bit.
What you're willing to buy.
Yeah. I mean, if you have the patience for that type of stuff. And it depends, some people like to play like that. I did for a little bit,
What happens if you buy something when the market is not open?
So after hours trading, I wouldn't do that just because then your purchase goes through or you're selling it. And usually the market is the most volatile at opening and close. So you might be like paying more than you would, you know what I mean? If you would have just waited until the market was open.
That makes sense.
Yeah. Okay. So, and the market is like 9:30 to 4, Eastern Standard Time. Couldn't imagine living in California. It's like the market opens at 6:30.
3 hours before us.
After
us.
Well, you have to wake up at like 5 a.m. to get ready to go to your finance job to be there at 6:30. I don't know. That's too much. I don't know how it works on that side.
But
I just know I'm happy being on
now
side.
It's so digital and so appy.
Everything's but still, if you're not awake and the market's moving, those are things like day traders. That's when they're reading those candlestick charts and everything like that, because they're making moves, big money moves daily. You know what I mean? But in order to do day trading, you have to like qualify for a day trader, or else you can get locked out of your account. So you can't just be moving money around like that. Yeah.
Wow. So much to know and learn and ask good questions. Anything else?
No, not really. I mean, I could talk about real estate investment trusts, but that was basically the only thing I didn't mention.
So I was I was listening to a podcast this morning, and please, I might say it wrong, and I don't want to, but they were saying like, okay, if say some are saving for that large down payment of a home, and she kind of was like, have money in your in the stock, kind of basically what you were saying. Have money in the stock market first, because once you make that down payment, there's unforeseen things that come with home ownership. It could cost you way more. Like, it's not, basically what I got out of what she was saying was, it's not always the best investment to do first before you have like an investment portfolio.
So the thing,
like, what do you think?
Well, the thing is that when you're investing, it matters how soon you need to pull that money out. So if you're putting the money in the stock market and you need it in 6 months, that's not a good investment, because in 6 months you might have not made anything. You might go down before it goes up. So that's another thing. When you're buying stocks, sometimes they go down immediately and then they bounce back up. So just don't be like, oh my God, I just bought it and it went down. Just don't worry about that. So when you're talking about like a large sum of money, like a down payment for a house, and you need to use that money within a short time period, I wouldn't invest in something like the stock market. I would invest in something that's more of like CD. Guaranteed income, more of like a bond. You know what I mean? If you could do like a 6-month bond, whatever it is. So bonds we didn't really get into. So bonds can be through companies, through the government, municipal bonds, whatever, through the, like the ones through our government. They used to be AAA rated, but because our country's in so much debt, we are now down to a AA rating for our bonds. But like any company, they could sell bonds to raise money for certain things, and you're guaranteed whatever the rate is of the bond when it reaches its maturity. Some pay, in increments, some pay, like a balloon payment at the end. I'm not too into bonds because they're kind of boring, so.
Thrill
I'm a little too risky at this point in my life. Maybe when I get older and I'll be like, I'll settle down for some bonds now.
This is fun. This is exciting.
Yeah. I like to I like the adrenaline of the stocks. You know what I mean? The up and down, the highs and the lows,
I also feel like you feel more sophisticated.
Yeah, I mean, it definitely, like, when you can have a conversation about finance with people, like, and other people are looking at you like, I don't know what you're talking about. You know what I mean? And that's scary at the same time, too, because it's like, they should know. You know what I mean? They should have a basic understanding. But
also,
how are we teaching people about, like, parallelograms? You know what I mean?
That's a whole nother conversation.
It's like, here's how you do your taxes. Yeah.
No, I agree. But it's scary, but I like that it's tangible for us all, because we, especially millennials, grew up in a world where it's like, men did this, or males on Wall Street knew, the only ones that knew how to do money. And now we it's tangible. We can all do it. It's accessible. The knowledge is out there, and you don't need all of that.
No. Yeah. I mean, I definitely think that, like, when it comes to like women versus men, when it comes to investing, like, yeah, I see the impulsiveness in men is like a lot higher.
And the ego around it is disgusting.
They want bigger risk, bigger reward sometimes. And it's like, okay, I'm watching you lose money, but that's fine.
My favorite thing is like when a female just has it all, like, you know what I mean? Full package, can invest, can make a deal. You know what I mean? It puts the boys to shame.
Well, I mean, I do think that like, as a society, the men are losing the Y chromosome and like women are taking over and we're starting to make more money. It's like, I don't know what's going on here. It's just to start reproducing asexually.
I think it's going to happen with the new robots that are coming.
Why do we like to end our podcast with robot sex conversation?
I believe it.
I believe in it too.
Pretty soon, if the men don't figure it out, the women are getting stronger,
right?
and more resourceful. And guess what? I don't know what's the point.
I mean,
and then the ones that cause drama, no space.
Yeah, we don't got time for that. We're just gonna talk to our chat bots.
No space for
you. Other robots.
So to wrap up this conversation, because we could talk about it all day.
Yeah.
What is something that you would recommend for somebody to do first if they're interested in this? Like if they haven't invested yet, what is the first thing you would want them to do?
I mean, other than figuring out how to open a brokerage account and what
there's nothing to figure out. You just told them it's Robinhood.
Yeah, but still, some people are just like, they don't know. It's like through their bank, how to, you know what I mean? Like that's what I hear the most is like, oh, I don't even know how to open a brokerage account.
It's not hard. I'm trying to clear it up. Clear up the confusion.
Figure out even if you're not like, oh, I'm opening my retirement account today, just open like a fun account. You know what I mean? Even that, like what I was saying, paper trading and everything. Do a lot of Googling, ask questions. You know what I mean? Like I forget which website it is, but like there's where you can look at like charts for everything, like over, like whether it's charts per president or charts over 100 years. I was just looking at every chart because I wanted to know everything, you know what I mean? When I was first educating myself on all this. So it's, I'm not going to say every single person is going to be passionate about it, but I do think that like just understanding the three major indexes, the NASDAQ, the S&P 500, and the Dow Jones Industrial Average, those three things will make so much more sense of everything else. Once you understand those three things and how those are the averages of those groups of stocks and how to follow them and how to purchase them through ETFs and what your brokerage account, blah, blah, blah. And then just like don't obsess over the day to day, which of course everybody's going to do at the beginning because you're like, oh, I made money. Oh, I lost money. You know what I mean? Yeah. So don't obsess over that. And then just kind of like, just educate yourself on these different companies, maybe like the future projections of certain things. Yeah. But people don't necessarily have time to do all of that. Yeah. So that's why I'm saying just stick to the average of the S&P 500 just because like overall that's like our country as a whole, So like I said, some years are going to do better than others. Some years the S&P 500 is going to lose money. But overall, year over year, you're going to make that 9%. So average.
Perfect.
There's so many other ways to invest, but that's what we're going to discuss today. It's just
we'll do part 2. Yeah, I like talking about this.
The basics of buying stocks, equities. You know what I mean? ETFs, stuff like that.
Thank you so much for
coming. You're welcome. Hopefully this was beneficial. Hopefully you guys like took some notes or revisited this, or just feel free to reach out
if you have to.
Or just reach out to me, ask me any questions if you have.
How can I find you?
I mean, you can find me on my aerial page. That's where I am.
Spell it out for them.
Spell it out. So I'm on Instagram, Ariel_Brooke, AERIAL _ I just did. AERIAL_BROOKE. And that's how you find me. Yeah. And in real life somewhere. Yeah.
You can reach out to me and I'll put you in contact with her.
That works too.
Thank you so much.
You're welcome.
All right, guys, until next week. See you then.
Thank you all for tuning in to this week's episode on the Marissa Effect. This is where conversations stick, stories spark something real. If today's episode moved you, made you think, or gave you a little inspo, please share it with a friend. And don't forget to subscribe, rate, and leave a review. It truly means the world. Until next time, keep showing up, stay curious, and remember your story has an effect too. See you next week.